that's also attracting institutional people who are understanding that this is a once in a generation type of technology.
Dan Tapiero, good to see you, my friend.
Raul, pal, good to see you. It has been way too long.
I know, it's crazy because this is actually an authentic catch-up because you and I haven't caught up for a while. We've been trying to get together. We've not managed it. I'm looking forward to this.
Yeah, me too. Me too.
So, as ever, let's start with the macro.
Oh, the macro.
How do you see it? Because
I don't remember when we last spoke, but I've been on the same theme probably since the summer, which is that, diabolical Fed tightening. You can go back and look at some of the tweets. I was just shocked that they turned at the worst moment. They actually went very aggressive to tightening mode, essentially at the peak of the CPI. So, and they've stayed that way. And unfortunately, I don't think I've seen it in my career. You probably haven't either. That the Fed is using the two most lagging indicators that we have, CPI and the unemployment rate, to make policy. And even they know and talk about, lags, lags with policy action. So it's a very strange thing that they have ignored all of the leading indicators that you and I have watched for 30 years that were very, very clear quite a while ago that we're going to have a significant decline in growth and inflation. So, I might put the question back to you a little bit. If, all of your travelings around the world and all the people you speak with, why do you think that the Fed has just blindly ignored everything that they've always looked at?
I was going to ask you the same question. My thing on this is politics.
Okay.
So I think politically, they need to say that they conquered inflation and that everything's going to be okay because people can't look forward. It's not their job. It's our job as macro people to do that. So I feel like it's part of that. And then I've got a bigger hypothesis that you're aware of, that they kind of had to jack up rates to really get them down. Because if there was any remnants of sticky inflation, which I don't believe anyway, but if there was any inflation expectations that didn't allow yields to fall, I think they're in real trouble because of the interest payments that need to be made. They've essentially, what my work uncovered is that almost all QE is just the monetization of interest payments. And that's okay if GDP growth is at 2% and interest payments are at 2%. If interest payments are at 4%, you've got a big problem because the government's 100% of GDP in debt and the private sector's 100% in debt. So I kind of think there's part politics because they just want to say that they've conquered inflation, although they're going to get the own goal of unemployment. So I don't really understand that. Maybe that's fiscal. But I think there's a bigger play, which is like, if they don't get rates down to 2% by the end of the year, there's a bigger problem to have. What's your view?
But the question is really, if guys like us, if it was so clear and is that inflation will come down and has, and I think next week is going to be a surprise also. I tweeted that last night. Why did they lose faith they really have lost faith in their ability to forecast. You say, well, they needed to make sure that inflation was going to come down. But we are all 100% sure for the last 6 to 9 months that inflation was coming down. They basically lost faith in their ability to assess the future data. And I didn't lose my ability. I didn't change. I didn't do anything different. I'm not the Fed. I don't have as much resources as they do. But this is frankly the easiest cycle to forecast, I think, in our career. It's extremely obvious, right, as you said, that the interest payments are a problem. But it's saying the same thing. The banking system blew up because obviously you have amateur local banks out there not knowing how to manage. And it's not really their fault. We had the worst year for bonds in, 50 plus years, and the 60-40 portfolio, I think you pointed out, had the third worst year since 1867. So I'm not pointing, I don't think there was any negligence. It's just very hard to manage an interest rate portfolio when the Fed goes crazy the other way on you. So meaning that the speed of the rise in interest rates, and you pointed this out often, was just too fast and not needed. And so, we've seen the distress, and the distress is the sign that it's over. And I take this back a little bit, have even a bigger picture thought. I mean, I don't want to say, should we lose confidence in the Fed? Has the Fed lost credibility? Everyone talks about that every cycle. But the reality is that somehow the way those 8 people or 12 or whatever it is sit around that table and make policy, and then there's one guy at the end who's the arbiter, just seems like and again, they're all basically academics. They're not market practitioners. It just seems flawed. And this is I remember Bernanke screwing up in August 2007 by focusing on inflation instead of the frozen credit markets. That blew up the markets for 6-7 weeks, and then he reversed. But, do people question that there's a flaw in the structure of decision-making here?
So the question is, are we looking at it wrong? This is what I'm trying to get through my head. Is it a political process now? Is there independence? Or is there a signal to the fact that Janet Yellen is at the Treasury and they are doing...
been together, Raoul. It's always been, you remember, Rubin had influence on the Fed back in 94 when Greenspan, each of the powerful, Geithner had influence. There's cross-pollination. I don't think there's any doubt. Like, I know you mentioned that in the letter yesterday in the GMI note, but I don't really think there's much doubt that they kind of make policy together. I mean, Powell, of course, is speaking to Yellen because she was in that role before. And, so I'm not surprised by that. I'm just saying, do people, especially the younger generation, the millennials who've sort of gotten shafted, a bunch of different times in their life, do they begin to question that this, authority, right, this single point of failure, we'll call it, this single entity, controls policy for the U.S., but really the entire world? And it just makes me think in stark contrast, we have this decentralized world building in the crypto blockchain, Bitcoin space, however you want to call it. And, that space has gone through tremendous upheaval in the last year, and it's doing just fine, right? And there was no government intervention. There's no taxpayer money. There's no brushing things under the rug. There's no, right? And so people start to say, wow, that's the digital asset ecosystem, as I call it, this decentralized, and a lot of it is decentralized world. And of course, at the crux of it, Bitcoin is a decentralized network. Does that work better?
Hey everyone, Raoul's Venture Crypto, it's really my flagship show. It's where I interview the best guests in the world, people you never get on another show. I think it's the best show in macro, crypto, and Web3 combined. In fact, that's what it does. It covers everything. But really, it's all about the revolution in Web3 and crypto. And I'd love it if you got it every week in your inbox. All you have to do is just click on the link below, pop in your email address, and you'll get notified every time it comes out. And you don't miss anything as you take my journey into the exciting new world of crypto and Web3. Thanks.
So play it through the minds of these young people, right?
Yeah.
So we have the pandemic. That was a big shock to a lot of people, right? And you come out the other side and suddenly you've got this massive inflation and everyone's taking a haircut of 5% in real terms and everyone's feeling impoverished, right? You've seen every business around the world, consumption has dropped. The next thing, the output of what Powell has just done is, oh, by the way, you got screwed from inflation and now you're going to lose your job. That narrative, I don't think people are thinking through. It is going to make people really angry.
Well, that's what I don't understand. Why is it that putting people out of work is the way to manage the cycle? That doesn't make any sense to me. I mean, and it's, of course, it's people in the middle and at the bottom, exactly the people that you really, that need the job, right? So putting them out of work is the way that we're going to manage the CPI headline number. I mean, it just doesn't make sense to me. And again, we both lived through a lot of cycles. We've seen how it works. But this specific case, it feels like, they did make a mistake not raising early enough. They then went too aggressive at the exactly wrong moment. And now they're focusing on the most lagging indicator, which is, people's livelihoods. All right. It just,
And when you add in the other third part of this equation is, by the way, the money you thought was safe in the banking system is not safe.
well, that's another thing.
And we caused it because the yield curve was too negative for the banking system to cope with, and short-end rates were too high. So that trifecta of things, I think you're right. There's a zeitgeisty moment happening here.
It might be.
It might happen.
It might be. It might be that it's the next time around. I don't know. I think that millennial group is potentially going to get shafted again. And, think about interest rates on mortgages as well. They're out there trying to buy a home, and the mortgage rate is ridiculous. And you see the data, mortgage applications are lowest in 35 years. The housing data, I think, will still be all down this year. So I think that there, that added point that you mentioned as well about all of a sudden your deposits might not be safe. Again, that points again to digital asset ecosystem, Bitcoin, Ethereum, that whole world developing. And
the other thing is there's something about the boomers that they have one fear, which is the 70s. I can't find anything that suggests we're in a structurally inflationary world. I just see a reverse and opposite effect of the pandemic, kind of like post-World War II. But these guys are so obsessed of their ghosts of their past. This is not the millennials' ghost. Their issue is all sorts of different issues. They've got a problem with technology coming into their workforce and competing with them at scale. They've got all sorts of other things. I just think it's been irresponsible, that 1970s dialogue. And I think you and I have swapped notes on it. It's like, this is not the fucking 1970s.
No.
For that, with a population that's aging.
Yeah, no, I don't know why. I mean, it was a narrative that's gotten pushed for a long time. It connected to this idea that a 2% CPI is the holy grail. I don't really think so. Like, why can't the CPI be 3? Like, does it really matter? We already have a lot of other inflation indicators that are pointing lower, but, this concept of we're going to stay tight until it gets down to that number also seems just very amateurish, right? Like, they're not really interpreting and analyzing and making judgments about the data in the way that you might if that were your job and you had 1,000 economists at your beck and call. It's very amateurish, and it still bothers me, and I've said this one of the other times that we've spoken, that there are no market practitioners, no portfolio managers. I know there's that shadow Fed committee that some of the guys, the successful guys are on, portfolio managers, etc. But I just don't know how they can make policy without having that deep experience in the markets. I mean, Powell is not a market guy, and this has gone on for a while. So, it just feels to me like, credibility loss. Maybe that just straight out happens through Bitcoin rallying, and there's no like big blow up at the Fed. There's no, the old traditional world just keeps chugging along, but then all of a sudden, Bitcoin's worth 300,000-400,000. And they're like, well, why did that happen? Well,
that's my view, is this alternative financial system attracts more people over time because the old one keeps proving itself to be unreliable and actually disadvantages people. So I think that's the case. It's been, both of our core assumption for a while that it doesn't have to be an instant migration like Balaji's saying.
Right.
That migration will come.
Well, it has already. I mean, in the middle of 19, when I launched my fund, it was $300 billion in value. That's the what I call digital asset ecosystem as defined by the value of all the cryptocurrencies and all of the equity of the businesses in the space was 300 billion. And today it's 1.7, down from 3.3 at the high a year ago. We tracked this very carefully, but $1.7 trillion is now the value that's in this new world, in this space. And, I hear all of this, and you and I go back and forth, oh, more FUD, more FUD. It's like, people are pointing to Elizabeth Warren. I don't know why. I mean, I don't know how she's relevant to anything. Barney Frank, probably, the least relevant politician I can think of. I'm just the choke point conversations, all of this stuff. But the reality is this is $1.7 trillion in this space after a 70 to 80% decline in the price of its leading assets, Bitcoin and Ethereum. So, and here we are, we sat through Luna, we sat through the FTX fraud. All these problems, regulation in the US, $1.7 trillion. I mean, it's true. And that's the proof in the pudding. I don't think there's anything that can take us back down. I don't know that we're going to have a raging bull market tomorrow, but I think for sure the low is in the space, and it happened on the FTX fraud. And on that fraud announcement, which to me was for the space the most surprising thing that will happen. He went from wonderkind to fraudster in the span of 6 weeks. Ethereum couldn't make a new low in price. Bitcoin made a new low, pop back up. As we know, old market guys, that's a bullish divergence. The selling's dried up. Let's not get too complicated about things. It's over. And now we have, in the last 6 weeks, real fundamental data to back up why that was the low, right? So I think it's setting up very nicely. We're going to have an inflation surprise to the downside. I'm not sure I'm quite as, bullish on inflation, dropping as you are. I think you're thinking below 2 this year.
I think we possibly headline inflation goes negative this year. There's a chance.
Yeah, that's a giant call. I mean, that is a giant call. The
other person who thinks that is Alex Gurovich.
Oh, Alex, yeah. Well, he's good. I mean, it's not impossible, but I think even going down to 2% would sort of have the net effect the same. Would have the same effect. So, yeah, I think the markets are going to be surprised, and that's also going to be very bullish for NASDAQ. And the banking system can continue to be impaired. I mean, how long? Credit Suisse was failing for 8 years. I mean, their bankruptcy was, no surprise. You used to post those charts once a year. Oh, it's like, it's going to move down. Right. Yeah. Chart of death. It was. So it was no surprise. And you know what? It could be that's now the chart for the U.S. banking system.
That's kind of in my head. It's like this. This feels like the European banking crisis in 2012 without the sovereign side.
Yeah.
It feels exactly the same. We saw the same in the Spanish banks, and we saw a shrinkage. You saw that chart, I don't know, it was on Twitter, of the number of US banks.
Yes, I saw that, yeah.
I remember that chart about Italian banks back in, where was I? I think I was still at Goldman.
That's
back in the 90s, thinking, oh my God, this is an outlier. They're all going to have to consolidate.
Yeah.
And they're consolidated by acquisition, and then they're consolidated by big fortunes to each other's hands because they're going bust.
Yeah.
The same thing, right?
It could be that's how the transition happens. Just slow degradation. They get stuck in this quagmire. If they couldn't make money when rates were high. Then they go back down, and maybe investors just don't think of banks as money-making enterprises anymore. And that was sort of what's going on here. Just think about it as an investor. If you make a judgment and i.e. you put money into 10-year notes and you lose 30% of the value. And then the Fed comes out and says, or FDIC or whoever it is, and they say, well, you lost all that money, but if you need to have that collateral marked at par so that you can make loans, you can. There's a free option to monetize your losses, and we'll give you that. It's like unlimited potential liquidity. So as an investor, you say, well, is that a business or is that a quasi-government institution? And do I want to invest in that? And so maybe the slow bleed of assets coming out of the U.S. system, I don't think it's going to Europe. I think it's going to Asia. I mean, it's going into this digital asset ecosystem.
The technology or the digital asset ecosystem, because that's the only thing. Because the other thing is you play that forward about, okay, you figured out the banks don't make money, and if the banks have lost money, the Fed just kind of papers over the cracks and injects the money. Well, the next part of this equation is that commercial real estate, which is like, we know that nobody's going back to the office.
Right.
You're running a global asset management company and you're based in Puerto Rico.
All right. I haven't called it global yet, but okay, yeah.
But you got people around in different countries, different places, right?
Yes.
And there's commercial real estate, right? That story is like the European banks. That's going to fester for a decade, and the Fed are going to have to put it on the balance sheet in one way, shape, or form.
Yeah, I don't know how that plays out. I mean, I think that's right. I don't think it goes to zero. People, still like being together. And New York City is a great place, a great meeting place for people. Young people like living in cities. So I don't know how that.
But let's say you lose 20% of all.
Yeah. No, I know.
That's a huge number. It's gigantic.
Yeah, I don't know how that plays out, but there's definitely quite a lot of overhang, and maybe that's sort of that slow. I don't want to call it deflation, but it's sort of it's connected to how much debt we now have sort of in the West, right? The debt. This is one of the reasons why the main reason why I thought it was not the 70s. We didn't have any debt in the 70s. And the global economy, I mean, look at Japan. Rates didn't go up as much there, but, there's no way that our West can handle rates like that. And so there's an overhang of commercial real estate. There's an overhang of, I don't want to say bad banks, because I just think non-capitalist banks. And then I had this thought that this concept of store of value is shifting, because many people invest in real estate as store of value, right? And I think it's certainly trillions. I mean, 100 trillion? I forgot the total amount of dollars or wealth.
Like 100 or 200 trillion. It's a huge number.
Yeah, it's a huge number. And, this was something that you and I talked about maybe 2-3 years ago and posted on Twitter, that the store of value component of, let's say, art or real estate was going to shift to this digital world. The finite supply of real estate, in theory, I mean, it's somewhat finite, hard to add a lot of supply in some areas, but, you have this finite digital collateral now, and it's just an easier place. It doesn't, in the case of Bitcoin, maybe doesn't produce income. I mean, Ethereum does, of course, produce nice income with its staking yield. But, I just keep thinking that that's how money migrates from.
That's a really interesting thought.
The whole world.
So let's say you're Nico, the producer, who's listening to this call. Nico, millennial, can't afford to buy a house. What does Nico do? Buys NFTs, buys crypto, because it's an asset, right? All assets are a future deferred consumption. So you buy a house now so you or your kids or somebody else can spend that money in due course. If not, there's no point having it. It's a utility. So assets are just deferred consumption. So if you're 34 years old now and you want to accumulate assets, but you can't afford a house, So digital assets become an obvious place.
Well, it's very easy. You just get, you open your, get a wallet and, you have your, buy whatever one, that you think is going to hold its value and put it on a ledger and, finito. It's easy. You don't have to go through all of the stuff that you have to go through to buy a home. But again, look, I think, home ownership's not going away. It's just that there's a component of real estate that people there's a component of it that for investors is a store of value holder, right? Just like gold is a store of value, but some of the gold money has migrated into Bitcoin, ETH. Look, whether people want to put it into punks or apes, that, whatever, that's up to them. I think that's a lot of, and the other chains right now to me are sort of still more venture. Only Bitcoin and Ethereum really have achieved network effect, in my view, and really sort of count as that. I don't think you sell your commercial real estate property to go into, I don't know, Dogecoin or something.
But you will get young people who can't afford, can't fractionalize it. So if you want to put 10% of your savings in, right, you can't afford to do that in a house because it doesn't pay your mortgage payments. So what you end up doing is looking for something else. I think that's your point.
Yeah, and I think that's how, and I mentioned this point before, I think that people always said, and you also always thought that there was going to be, what was it called? The debt jubilee. And I remember once we were talking about this, I thought, there's never going to be a debt jubilee because the result is too cataclysmic and horrible. What's going to happen is all of those hundreds of trillions or whatever it is, 100 trillion of debt that exists in the West is just simply going to get devalued against Bitcoin, ETH, and the assets in the digital asset ecosystem. So if that's value today is 1.7 trillion, if the value of all that debt stays constant and all the value of all the assets in the old world, let's just say stays at a certain place, or let's say it goes up 100% over the next 10 years, the value in the digital asset ecosystem will be up 10x. And so what will happen is that there won't be a debt jubilee. It's just that people who own all of their assets in the old world get devalued versus all of the people who are in the new world. And it's a very subtle shift. And all of a sudden, people in the old worlds are like, well, I thought I could afford that, painting or that house or that car. And now I sort of can't, but I see that this younger guy who is in this project or in whatever, he can. And I think you're starting to see that a little bit.
That's true. If you think about that narrative, the kind of Lambo narrative or the Miami narrative and these crypto guys, it's exactly that because their purchasing power is outperforming the TradFi guys. Big time. And look, I think you're getting some TradFi people moving in, but it's still slow. Based on our accounting, only 4% of the world right now have digital wallets. And that's sort of equivalent to 1998 in terms of the adoption of the internet. That's when 4% of the world had access to the internet. So it's still very, very early. I know it feels late because every year in crypto is like 5 years in TradFi world, and I don't know how we're surviving it. I mean, you and I, older guys, we're actually enjoying it.
Yeah, it is fun, and we know how to manage it, but it really is fast-paced, fast-growing. I do think the traditional world is slowly getting that, there's real, this is real, that there's real math behind it. The Satoshi white paper is not some fictional nonsense. It really is an important invention. And, the initial concept that supports and backs Bitcoin and the Bitcoin network is, like a find. It's a great invention. Yeah.
Conversations with investors. Now you're onto your fourth fund now.
Yeah.
Your conversation with investors, when you started, a lot of what you saw was family offices, right? They got it. They were bigger risk takers. They understood the opportunity. Are you seeing that broaden out? How are you seeing the evolution of the investor base?
So this is interesting because I just got back from a month-long trip. I've never done a month-long trip. I was in Dubai and Abu Dhabi and then Riyadh and then Melbourne and Sydney, and then I would dropped it by in Auckland and then up to Paris. So I really got a sense. I want to say something about that. But in the beginning, yes, it was more family and really just friends of mine and my people in my world network. And but now we did at the tail end of the third fund, a little bit in the second, we did start to see more institutions. The Texas Teachers is an investor. We also have the Michigan Employees Pension Fund, MERS, they're an investor. We have an endowment. We have some foundations. So, but right now it's really picking up. And you'd be surprised. It's for people who have no exposure, but who sort of, especially in the last 6 weeks, they're sort of seeing, oh, well, Bitcoin's up 70% on the year. Is that what it is? Or 30% during this banking crisis. And you know what? That kind of makes sense. And they didn't need a bailout in that world. And there are some bad actors, but there's a lot of value there and a lot of different things going on. There's DeFi stuff going in the DeFi world. There's stablecoin business. There's NFTs, a lot of different things. They're now ordinals on Bitcoin even, so there's the space itself is not just relying upon the price of Bitcoin and Ethereum. That's the big difference to me from 18 and 19 was that, there's so many things going on underneath the hood. The number of developers that have entered the blockchain space is now at an all-time high. So through 22, it kept increasing. Of course, you have things like the Bitcoin hash rate. It just hit an all-time high. The number of players in the NFT space, from 18 months ago is up exponentially. So there's the number of layer ones that have had the sort of the top 5 or 6, the usage is at an all-time high. So, it's no longer just about the price of, those 2 leading ones and, some of the other cryptocurrencies. So I think that's also attracting institutional people who are understanding that this is a once in a generation type of technology.
Yeah, I think if we go back to whenever it was, 2018 or 19, when we had our first conversation on Real Vision about this, the big difference between then and now was the applications layers being built.
Big time, yep.
And they get that, they see that, and this is closer to, the last people in will be when it becomes ubiquitous and everybody has it on their iPhone. But it's this application layer, the consumerization and the integration of blockchain technology that's big.
Yeah, and it's not through what we expected. I mean, you see all these name brands coming into, incorporate blockchain into their business models. And of course, I know you saw this a few weeks ago, the California DMV is putting licenses and title deeds on the Tezos blockchain. Now, I don't know why they've specifically chosen Tezos, but the point is you have a non-economic, non-capitalist entity basically at the cutting edge. I mean, this is, I think, a fantastic use case. And so...
The Argentinian airline with ticketing.
Right.
Something I've been talking about, and suddenly there it is.
Exactly. So I think you're getting, adoption through ways that we hadn't anticipated, because once you have a digital wallet, it's just a short, quick step to understanding that Bitcoin is collateral, Ethereum is programmable money, that there are different things that you can hold in this digital wallet, right? It doesn't just have to be, your license, right? Your license that sits on a blockchain. So I would also say one more thing, because I want to just mention my trip, because you asked me about, has the interest been broadening? I mean, the Middle East is really on fire.
I'm hearing the same from everybody. Tell me about it.
Well, they get it, and they're embracing it. They see that it's the future. Abu Dhabi specifically, Dubai too, encouraging businesses to set up there. There is in Dubai and also in Abu Dhabi, there is a regulatory framework. I think people, of course, are looking to the SEC, regulators around the world, but the SEC is going backwards and the U.S. is moving backwards. And again, I've said this before, this is the first time in 50 years that the U.S. has not been leading technological and financial innovation. We invented the mortgage-backed security market in the 80s. There are things that we always were leading, and now we're at the end. I mean, we're in the caboose. Look, I also think other places, and you see this in Australia, they really understand currency. You could stop anybody on the street and ask them where the Aussie dollar is, and they'll tell you. Americans don't think about currency, and they think about the NASDAQ, but they don't think about the dollar. They don't really know where it is. So the concept of cryptocurrency there's a hurdle there. And, adoption is just slowed if there are hurdles, any hurdle. And so crypto and currency, it's just too strange for them, right? But the Australians, they're entrepreneurs. They live on a big island. They look out. They always look for investment opportunities. Very wealthy population, generally speaking. And they really get it. And I was there and I had a lunch at one of the larger banks, and they've already tokenized an asset and put it on a blockchain. They're, pretty advanced in that sense. I don't know that there's any trading volume on it yet, but they have people well-versed. That's not to say, look, JP Morgan has the largest number of blockchain patents in the world. So even though Jamie Dimon is saying whatever he's saying, under the hood, they're doing stuff. But I feel like in Australia, the things are coming together, the tech innovation, the currency part, the money part, and it's the same thing in the Middle East.
Yeah, I get the same because I've heard a lot from, everybody, all of my friends are all in the Middle East all the time on this endless road trip because there's capital and they understand that the fossil fuel economy over time is going to shrink versus the renewables economy. So they're like, well, we need to have a stake in the future. And they've been very strongly behind this.
Yeah. One other interesting thing, because I topped the trip off with a few days at Paris Blockchain Week. And what you realize is that every region has its different focus on what they are extracting from this digital asset ecosystem. So you find a lot of the luxury brands in Paris are very interested in figuring out how to issue NFTs to get closer with their community. How do you develop that relationship with a product better? That's somewhat of a focus in the US, but like for instance, there aren't really any OG Bitcoiners in France. There was no one in 2010, 11, 12. Whereas in the US, you go to Bitcoin Miami and you have 25,000, Bitcoiners, guys, who are also mining it from the beginning. If you go to ETH Denver, that's a little different focus. Out on the West Coast is more about the tech. Europe, France specifically is, this luxury brand focus. The Middle East, I think, is sort of everything combined. But also remember, those currencies are pegged. The rial, the dirham, they're pegged to the dollar. So I think for them, they also understand that they need to have a diversification of their assets outside of having 95% in the dollar and then, 10% in the euro. They get the concept of currency diversification. And then in Asia, they also have a different focus. I feel like that's more in Korea, for instance, blockchain gaming, right? And there's a big gaming universe in Asia. There are gambling platforms that are legal there as well. And so what's interesting is it's not one thing, this space now. It's many different things, and it's many different things in different areas. And people say, oh, well, the U.S. is just going to regulate it all the way. Well, 85% of total world crypto trading volume is done outside the U.S.
And my view on this is like, you and I saw this, is the US, after they left the gold standard, tried to restrict their currency. So the FX market started in London and became huge. Then the US was like, well, we're not going to lend to you foreigners because we're still trying to protect our own economy. So the UK developed the Eurodollar market, which became the largest market, that and the FX market, the largest markets the world had ever seen. Then the US made a third strategic mistake, which was, we're not going to let our banks do OTC derivatives. So we're going to change the capital reserve ratios for banks. And the UK changed it and said, no, we're just going to arbitrage you. And they won that entire business. And only after Brexit and other stuff did capital go back, i.e. the financial centre moved back from London. Because if you remember, well, if you think how many times have you travelled to London recently, it's very few. How many times did you travel in your career? It was all the time. Because all the capital was there and all the people.
But I think what I've heard whispers is that the UK is making progress on the regulatory framework and for blockchain crypto. And I think, you may have mentioned this, but maybe I've read this somewhere, but I think that they could do that, what you're calling regulatory arbitrage again. I mean, just think about this for a second. We've invested in 26 businesses over the last 2 years. And I keep saying to people, I think, look, there is one large crypto business that's public, only one, it's Coinbase. It is impossible to think that 5 years from now, there is only going to be one public crypto business. And so, part of my focus is going to be figuring out how to get some of our businesses public. And it's not clear that it's going to be on the NASDAQ, which is kind of a shocker in a way. But look, if you took our 26 companies, I think any exchange in the world, if they're not going to, but if they were public entities tomorrow, they would overnight become a hub, for crypto blockchain. And
where are these companies based that you're investing in?
In our portfolio, 65% are outside the US because I diversified. I wanted 1/3 in the US, 1/3 in Asia, other 1/3 in Europe. And so you'd be surprised. There are a lot of interesting, great businesses outside the US. As it makes sense given the focus outside the US. So I'm just saying, you could have an exchange somewhere, whether it's Dubai or UK, that if they decided that, wow, some light bulb switched on, or you've got a 37-year-old guy running the regulator, like I met the economy minister in Dubai, he's 41. He gets this almost better than anybody I'd met in terms of, in the legislative area. But if you have someone turn a light bulb and say, hey, we've got a few years, the U.S. is going to get it eventually. They're not getting it now. And it's just as you said with the UK, maybe the market really develops there, right? It's certainly possible. That would be it's not, unfortunately, it's not as liquid as it would be on NASDAQ, etc. But it just doesn't seem like the U.S. is coming around.
It's only less liquid now. I mean, the FTSE used to be liquid. They've just got boring old companies that are commodity companies, a few dead banks and stuff like that. So, I look at it, and the UK has got a problem. It's got no growth industry, a bit of fintech, that's it. It's lost the capital markets to the US. And here's a $1.7 trillion business. And it's just a regulatory arbitrage business of which they understand, and they want to regulate it. And we know that if Coinbase tomorrow, if the UK said, yes, we're in it fully, Coinbase would relocate like Goldman did and every single investment bank did. All of their talent pool ended up being in the UK. It's easy.
It could be. I mean, it really could be. It's an open field right now. And, I was going to say part of the issue in the U.S. is that the leadership is all, they're all 80-year-olds, literally 80 years old. And I think what the U.S. needs really is just younger leadership. And it doesn't even really matter which side they're on. A 40-year-old sort of gets the future. And, you look at some of the Middle East leaders, they're in their late 30s, 40s, and they have 20-year plan.
MBS is
38. He's 38. Yeah, and they have 20-year plans. They have 30-year plans, or at least visions. Biden doesn't have a 20-year vision, and I don't think any of them do. So I think, look, don't
Can all be dead in 20. Dan, you can't have a 20-year plan if you're all going to be dead.
No, that was the point.
Yeah, I know, but I just trying to spell that out for people.
No, that was the point, right? Like it's bad now. It's bad. And maybe this leads into the next point. If you can't even figure this world out, what are you going to do with ChatGPT? You've been talking about this a little bit. I appointed just on Saturday, one of my guys on my team is sort of head of ChatGPT within the firm to figure out how do we incorporate it into our processes, and also how do we incorporate it into our investment decision making, not just the process, but looking for companies that are integrating, blockchain with chat. And I think that's something really interesting, or AI, because I think the blockchain does have a purpose there. We're still trying to figure it out, but there are going to be companies popping up.
So my two ideas for that, obviously digital ID that we've all talked about, and that's a no-brainer. But the other one is Emad. I think you might have met him at Global Macro Investor Roundtables. He was a GMI guy who built Stability AI. He was a macro guy. Emad Mostak. You must watch the 2 videos I did with him if you've not seen them. Okay. They're mind-blowing. He's a macro guy.
Okay. I will. All right.
Building the largest open source AI in the world. And I spoke to him. I said, well, why the hell don't you tokenize the use of the data?
Oh.
Because that allows everybody to participate in it, as opposed to having to buy the equity, everything else. We can all participate in the ecosystem because it's going to replace humanity in various ways. You need to offset, because it can't just be UBI, but the Yatsui idea of universal basic equity is this. Let people participate in this change and don't just keep it to bloody Google or Microsoft.
Yeah, well, that's a very interesting idea. What did he say? I guess I have to...
Well, I think he first wants to IPO anyway, but I think he knows blockchain. I mean, he's all over the space.
Mm-hmm.
So I'll just keep working on him, because I think it's exactly the right use of a universal data set of such power is tokenize it. So then if you are building an application on top and you're drawing a lot of the data, you pay for it with a token. And if you're putting data in, you can receive tokens. And that creates an economy. Huge economy.
Yeah, no, I mean, that's an innovative thought. I like that. Yeah, I don't think there's so much to fear here. I understand. Italy banning, it just seems like, the most backwards guy banning it. I mean, isn't that a buy signal? I mean, my goodness, right? It's like the worst trader in the world selling his thing at the low. It's a buy signal. So I think it augments our, functioning, right?
Yeah, and maybe it's too far into the future to worry about the other side. I just think it's a renaissance for humanity, really, if we leverage it. So let me focus in a little bit on your portfolio right now and what kind of investment opportunities you're seeing. Are you seeing mainly secondary?
So yeah, there's just so much opportunity right now. I don't think I've ever seen so much. In Q4, so I'm probably one of the few private equity guys that actually likes the cycle. I mean, most guys, as you know, they have a 5-year investment period because they want to invest through the cycle. I have a view on the cycle. I thought Q4 was the low. We invested over $100 million into 7 different businesses, October, November, December. 4 of the businesses were through the secondary that we bought at 50 to 80% discounts from previous rounds. And so who's selling? Funds that want to get out of crypto for whatever reason. A partner moves on and they have a portfolio they want to reduce. You have founders or, co-founders who need money. They want to buy a house or whatever it is. You have seed investors who say, well, I missed the $7 billion valuation, but I'll sell it too. And some of the discounts are pretty dramatic, and we're very active in the secondary. Of the $1.2 billion, we've deployed $600 million of it is in secondary, half. And so, and I think that's the largest amount by multiples and multiples of anybody else. So we have tremendous reverse inquiry. Anybody who wants to sell stock in a business that's sort of on our radar above 5-10 million, we're the buyer, and it's uncompetitive at the moment. Like, we are basically just saying, this is our price. We want to pay, X multiple of revenue, and, we're a 10-year life fund. So we can buy now and take advantage of it. And that's the reason for raising money now for another fund. The first close is going to be at the end of June, is because these discounts are dramatic. I mean, I can just, you have companies like OpenSea where there's stock in the market now at, you can just call any broker at 90% discount. And you've got, some of these other bigger companies, even Alchemy, a lot of these companies that raised at 50 to 100 times revenue in 21 and 22, you can buy their stock in the secondary at very attractive valuations. We also led 3 rounds, in fact, of companies. And I wouldn't say that, we set the pricing. I wouldn't say it was super cheap. It wasn't. One of them was, reasonably, I think there were more reasonable prices. These are businesses. Well, one of them, QuickNode, got some press. We invested $40 million in QuickNode, $720 million pre-money valuation. I think, that's an API node infrastructure business that competes with Alchemy. Alchemy raised at 100 times revenue. And so we paid a fraction of that. I think 100 is crazy. I think even what we paid was a little rich, but very happy to own that business. And that's one of the few businesses in the space that actually made more money in 22 than in 21. So in the portfolio, we've got 5 or 6 companies that made more money, if you can think about this, in 22 than 21, even though the space had that massive correction. And so this sort of speaks to my general thesis, which is that the fund and what we do, we're not going to be the number one performer in the space, but we're not going to have the volatility. And, our target is still to make a 5 or 10x on the portfolio over 10 years. That's going to underperform probably some of these other funds, but many of those, especially venture funds, are down 90%, or were down 90% in 22. So the one thing I would say that's still surprising to me is that, as far as I know, we're the only growth equity fund that exclusively focuses on crypto and blockchain businesses in the world. Like, I don't know why the other guys haven't come. It's amazing. I don't know. It doesn't make any sense to me. You had some of the traditional guys come in, like, Tiger and Thoma Bravo, but they've sort of moved out. And I don't know. I think I'm counting my days till Blackstone decides they're interested, and then it's over for us. I have, no airs about that. I think if some of the big guys really decide that they need exposure in this space, the growth has been crazy. And, when we started this in the middle of 19, there were only 14 businesses in the world that had a valuation of over $1 billion in the space. Now there are over 100. At the peak, there were over 150. So I think that there's going to be not only just more money coming into it, but by the end of 24, I think 25, you're going to see, these companies, many of the better ones as public entities. The founders want to become public. These guys, they're not quite ready in some cases. They need to be a little more corporate. They need to figure things out on governance. They need to build a board. Remember FTX? FTX had one board member, and that was his father, right? Like, if that wasn't a red flag, thankfully we passed on that 3 times. But you have companies that are making a fortune, but still aren't quite ready for the public realm. But I think by the end of 24, 25, there are going to be quite a few. And I think we're going to be very involved in that whole process. So look, lots of opportunity, not just in the secondary, but we're not really competing against other people. in these raises. So
Yeah, it's not like you're overpaying. There's nobody else showing up. It's not like, oh, we've got no competition because we're SoftBank and we overpay.
I know. So look, I don't look. This is one of those inexplainable things, I guess. I can explain it. Look, traditional private equity isn't terribly comfortable with macro. They're not comfortable with currency, right? A lot of them don't even do tech. So this is sort of like the really big money. Blackstone is still buying more real estate, right? Look, they have $1 trillion business. They can do whatever they like. But even the tech-oriented guys like Thoma Bravo said recently, a few months ago that, they're not finding, companies of the quality that they need or expect. And I don't know, we think that they're there. Maybe we're a little further out the risk spectrum than they are. But we also think it's an opportunity to help them get there. And so when this is the only thing that you do all day, every day, and again, we don't invest in the underlying cryptocurrency. A lot of our institutional investors are legally not allowed to. And so what we have is a much lower volatility. Our portfolios, for the most part, hardly marked down. Marked down a little bit, but not that much. And we're able to withstand the kind of volatility that's in the space. And look, as you know, that's always been my main concern. How do you get stuck in and hold the position for 10 years in a space that every 3 years has a 70 to 85% correction? You're going to get blown out. We know this from our old portfolio management days in the traditional world. You could get blown out, or your boss, doesn't like it when you have a down year, right? Or your investor.
Because there's only family offices or individuals like us who can stomach the cycle. We kind of know the cycle's there. You add more when it sells off, and
right,
that's it. But yeah, the amount of hedge funds who were in the space and now left the space because suddenly it doesn't go up in a straight line.
Yeah, it doesn't go up in a straight line. And if you can take a 5-10 year view, you're going to make money. This is inevitable, inexorable move up in the value. And we think, I think we've built a fund structure and a way to tap in to that value accretion without the panic and fear and all that other stuff that a company's holding, the rocket fuel. Because this is really the hardest market I've ever seen to trade. And, I'm a professional at this. And you have a lot of non-professionals. I don't know how they hold on. I'm glad they do. It's fantastic. They're true believers. That's great. But let's be clear, it's very hard. And so I call our strategy a, sleep well at night strategy. And, if you're a little older and you want to put $50 million to work, it's just very hard. It's not straightforward. And we actually have quite a few investors of that size putting big chunks of money to work in these businesses. And sometimes we get a little lucky and we have businesses that even make more money during bear phases, which means that during a bull phase, they could go up 5x, 6x in revenue. And so I'm thinking that we end the year higher. I don't know what your forecast is for Bitcoin and ETH for this year, but I think post the halving in the second half of 24 into 25, we're certainly looking over 100,000.
Yeah, I think this cycle is not 2019. So I don't think we get the long pullback correction. I think we'll get a running correction sideways, much like 2013, 16, those kind of ones. So that leads me into the final question. Is clearly you were like Fox with this 20th Century Fox. You had the name 10T. You're like, this space is going to be bigger than 10 trillion pretty soon.
Yeah.
It's going to look out of date.
Yeah.
Right?
Yeah, I think so. But you know what? The when it was 300 billion, right? The name of the first three funds I called it 10T because 10 trillion, I thought we'd make it 30x in 10 years. But I'll tell you something, I was already realizing that the name wasn't going to be actually the right name. It was last year I was on a panel with Dan Moorhead and Mark Yusko, and the final question of the panel was, what do we think the value in this ecosystem is going to be? The digitalized, the whole thing. And Dan all of a sudden throws out 50 trillion. Okay. And I'm thinking to myself, I was going to say 10 because that was my view, and then Mark is next, and Mark's like, well, I think it'd probably be more like 30. And so all of a sudden, here I am on this panel as the most bearish guy. And I said, well, realistically, okay. I mean, 10 was, I think, a realistic view. It's probably 20. I said 20. But, the reality is, Dan is, I think he's probably right. And the timing on it is not, you don't know. That's the hardest thing about macro. I always tell people, it's just sometimes macro takes longer to play out than you expect. And you really have to be stuck in. You really have to, and that's part of the reason for our strategy is that I just want to be there 10 years from now with the portfolio I have. I know we're going to make multiples on our money. And I think we're going to be able to do it without, having to panic every 3 years because something happens or the space, collapses or whatever. But we're in a good position now, and I think it's empty. And think back, and you were earlier than me. I remember that round table that we did in Cayman in 2013. I think it was, where Bitcoin was your number one choice. I mean, if we go back to 13, and I think you were bullish even before 13, do you think now is sort of the best time that you can recall? I mean, I understand the price is lower, but
yeah, yes, I think it's the best just risk-adjusted reward ever. And I said that last cycle, but I think it's the risk side of the equation has shrunk.
Yeah.
The reward side is still unknown, but ridiculous. When I first did that first ever macro strategy piece, I said, look, I think Bitcoin's worth $1 million. By when, I don't know.
Right.
It kind of feels like, probably. By when, I don't know. And so therefore, here we are at 30,000 today. Well, find me another trade on Earth that's as good as that. And Bitcoin will underperform some of the others in the space.
Yeah. I mean, I think you pointed out the chart. I also looked at it. We go from 30-year view or 10-year, 20-year view to the daily, because we can do that. But that chart looks like it's about to explode. I mean, Ethereum looks to me like it's about to go up 500 points, like imminently.
I understand. Mm-hmm. Then if you look at the ETH Bitcoin cross, the monthly version of that, it's just a huge wedge. I'm like, okay,
but they're both going up. They both have different uses. And, I think that the difference now, and this is the last thing I'd say, from every other cycle is that there are so many things going on in this universe. It's not just, 17 was just this pump and dump with the stupid ICOs and people ripping people off. Like, it was terrible in a way. This is not what it's about anymore. It's a large space with a large amount of value and many, many use cases. And it's incumbent upon the traditional people to do the work, right?
And look, if we go back to when we first had our chat on camera, like obviously you and I have talked about Bitcoin and crypto.
Summer of 19, I think. Summer of 19.
And so we look at that. Since then, Real Vision has integrated NFTs, digital wallets, digital IDs, all sorts of stuff. Then I built an entire asset management business, which is a fund of funds, just investing in that space. And then I built another business which tokenizes the world's largest cultural communities with all the big brands. That's how fast this has changed.
Right.
You've pivoted your entire life. I've pivoted my entire life. Alan Howard's pivoted his entire life. I mean, it's unbelievable how much is being built here. And we're all building different parts of this ecosystem out. And we've all got friends who are building other parts of the ecosystem out. It's ridiculous.
Right. And it's still incredible. Don't forget, only 4% of the world have digital wallets. And so, you think, when is this going to end? But maybe in a way it hasn't even started yet. I mean, I hate to say it ended. It just ended up becoming AI. What's that? Yeah.
The internet never ended. It just became AI in the end.
Yeah. Yeah, I know. It's incredible. We're living in great times now. And I don't know, there's so much negativity. I posted last night, Twitter, the most like negative for the longest period of time that everyone's ever been. That's why I say, is this the best time that you've ever seen? Because I can't remember when people were so diabolically negative, and yet the opportunity was so clear in a way.
I wrote that in the GMI that you just got yesterday.
Yes.
I think this is the best macro setup of all time that I've ever lived through.
It's incredible.
Yeah. Good.
All right. Well, hopefully we get some of your listeners inspired to dig deep and do the work, the ones who haven't.
Exactly right. Brilliant, my friend. As ever, good to catch up. We'll try and catch up in person somewhere in the world.
Absolutely.
You've missed the GMI roundtable. It's in Mallorca this year. Would have been.
Whoa. Next year.
All right, my friend. Good to see you. It's really interesting, having not spoken to Dan for a while, to see his line of thinking is very much in line with mine. Where we are in the macro, what this means for this adoption of the Bitcoin life raft or the digital asset life raft. You know, he completely concurs with my view that it happens over time. We get these accelerated moments in the booms, and then they pull back. But each time there's more people in Noah's Ark or the life raft. And I think that's really interesting. Really, also, Dan is like on his fourth fund. I mean, an incredible business he's building there. Really interesting to see his unwavering belief in where this space is going, seeing through the volatility, seeing through the macro and saying, let's just keep going there. It's a matter of time. It's all about time horizon in this space and how to structure your life that you can accept the volatility. So again, as ever, amazing conversation with Dan. I hope you got a lot out of it.
Hey visionaries, thank you for tuning in. For more free crypto content like this, head over to realvision.com/crypto. You'll get early access to the most brilliant minds in the space to cut through the noise, get in-depth analysis, and get you ahead of the curve with unbiased insights.